Okay, so good morning, everyone, and welcome to the Macro Snapshot. We are Friday, April the 4th, 2025, recording this about 7 o'clock in the morning. Okay, guys, so obviously today we have non-farm payrolls and we have Jerome Powell at 11:25, I believe. But what we're seeing, we're waking up here to pretty big news, all things considered here. You see that here, the news came out at 6:21. China imposes export controls. No, that's not the news. The news a bit earlier, China announces extra 34% tariffs on US goods. So extra 34% tariffs on US goods, which of course is the same number which Trump announced on April the 2nd, a couple of days ago on Wednesday. So this looks like sort of the first pretty serious retaliation from a major economic power. China's slapping 34% tariffs on. It looks as though Europe, there's sort of some talk that Europe on Monday will come out with their sort of retaliatory sort of tariffs. And as you can see here, just looking through everything, copper plunges more than 5%. And just looking at all the market reaction here, very pretty big moves here. We continue to overnight risk off. And this is just basically continue that. You see the VIX here absolutely ripping here, almost up to 40 at this point. So this historically is getting into, some of the most extreme levels. We've gone above, some of these sort of 30 levels. We're getting up there. At some point, VIX often mean reverts. It'd be a brave person who sort of shorted it just now, but that is an interesting one because we're getting to a point here where VIX futures could go into a mean reversion, but they may have a little bit more to go. We shall see. So VIX up. Obviously, everything else down. We're seeing here that the S&P futures just continue sort of to tumble. We're now getting towards interesting levels. We're getting down towards that 5,200 level, which is possibly going to pause pause this fall off. But what you can see here from a technical perspective, if you look at this sort of red box here, this is the Fibonacci extension going back to the beginning of the fall, so 19th of February, and you can see that this Fibonacci extension measures out basically to about 5,200. But we are getting into sort of levels where there is a little bit of horizontal support potentially, and maybe a little bit of overextension. But of course, this is very much a sort of a risk-on environment, and it looks as though what China is doing is to, as I say, to retaliate in a very sort of strong way, possibly European, possibly Canadian retaliation coming on Monday. So it looks as though we are getting to some kind of I don't want to use the war word, but some kind of sort of global tariff kind of battle. Tit for tat, which is not great for sentiment. So obviously, Nasdaq down as well, down a lot. Basically, everything tumbling. We see the Russell down over 4%. So the Russell being absolutely slaughtered here, having a horrible time, breaking down through levels. So it's important to note that even though there can be horizontal levels here, like we saw at the Russell at 1910, it just cut straight through there. So the point is that none of us should be surprised if the S&P, maybe, who knows, over the next 2, 3, 4 days continues to go down. That's an interesting level down there at about 51.23 on the June future, actually the continuous contract on the S&P. No surprise that everywhere we're getting a similar kind of reaction here. You see in Europe, we've got the Euro stocks sort of collapsing. We've got the German stocks down. And it's going to be interesting. Let's have a quick look here. See China. So if we look at the A50, not down as much. I mean, down, but sort of not collapsing as much. Maybe a bit of patriotism there. The Shanghai 300. I wonder if that's open at this point. I'm just kind of curious. No, that's not opened here. So that hasn't been registered yet. If we look at, let's say, the Aussie market, that's obviously down as well. And I'm expecting here emerging markets. You see here EEM, the pre-market, sort of down a lot. So just like a lot of pressure, a lot of pain everywhere. So in terms of bonds, what we could expect is a rally. We're seeing that the German Schatz, the front end of the German curve up. We just looked at, let's see, look at the Italian bonds, the French bonds up 73 ticks. Italian bonds. And what's kind of interesting as well, if you look at the German bonds, up 139 here. So finally, that Italian spread, just kind of curious here. The German bonds here outperforming the Italian bonds here. And you can see here that finally on that risk off, you can see here that the yield, the spread between Germany, Italy, and Germany finally sort of breaking out of its doldrums and sort of going up now 1.21%. So basically risk off everywhere. As we've indicated, what's actually a crazy move here is that the ZT, so the 2-year futures up a lot. Also more than we've got the ZF, we've got ZN, and we've got ZB, and we've got UB. So all along the curve. So this is very much a front end led bull steepener. We can see the curve here, if we just can find it here, steepening, which have a look here. Let's say, oh, where's my curves here? Yeah, let's say the 230. So you can see here that's steepening, sort of a bull steepener, so being led by the front end here. What's interesting, just to look at the metals, is gold doing okay. Gold sold off yesterday, gold doing okay, but things like silver, which is much more exposed to sort of industrial usage, you can see here absolutely collapsing. And some of that as well, you also see here copper down a lot. So copper absolutely collapsing along with silver. And some of that as well, apart from this sort of very much risk-off sentiment, a fear of global slowdown, is also the fact that a lot of the copper and the physical silver had moved into the COMEX sort of warehouses in the US, trying to front run potential Trump tariffs. But it looks as though there won't actually be any tariffs on the precious and semi-precious metals, industrial metals. And so some of those traders who were trying to arbitrage that have probably been caught way too long. And there's probably like a little bit of a long liquidation happening here. And again, if you combine that with the risk-off sentiment, pretty horrible levels. And if you look at what's also interesting, I signaled this the other day, the gold-silver ratio. And what's interesting here is that this is absolutely blown through this 92 level. So this is the ratio of gold to silver. And this is historically getting, well, very high, basically, in favor of gold. And what we've been seeing over the last, going back to 2023, so going back a couple of years, is that every time this gold-silver ratio has hit 92, it's actually been capped there. So this is a significant development here in favor of gold. Now, does that mean that silver is the buy? I have to say, looking at silver here, we've come, if you look at, actually that fib level is no longer valid. We'd have to put it up to here. So let me just get rid of this. So you can see here that we're just here getting to the 61% fib retrace. So if you're feeling brave, I mean, this would be an interesting time if you believe that, gold and silver can outperform. So maybe here a long silver, short gold. But, as I say, we're in a very much a risk-off environment, so a tricky one. And as you can see here, gold on the day actually up a little bit, not massively, but it's just reversing some of that. So very much a risk-off day. If we look at BTC, you can see here the BTC not actually reacting too badly. So that's for the coiners, that's a good one just to see that, there's very massive risk-off environment, BTC hanging there pretty well. It's going to be quite interesting to see if there's continuing risk-off if BTC maintains that. What's also interesting in the currencies, we saw a little bit of a comeback of the US dollar just overnight. I'm just kind of curious if we're looking at it here, you can see that hasn't really sort of it continued, and I just wonder what point the risk off is that just going to be reflected in the yen. So you can see here the yen, well, the US dollar down a lot versus the yen. So the safe haven flows are flowing there. And if we look at the Swiss franc as well, very much the Swiss franc doing well. So the traditional havens of the Swiss franc and the Japanese yen really are performing very well. And you can see here that something like the US dollar in general not doing that great. And you see here against the euro, I mean, the euro had a big up day yesterday. It's not ripping today, but certainly not doing too badly. And you see that risk currencies like the Aussie down, presumably the New Zealand dollar down quite a lot. You can see the Canadian dollar down a bit as well. So really here we're seeing the risk of the safe haven currencies, the yen and the Swiss franc doing very well. The dollar, it's a mixed bag against the high beta currencies like the commodity currencies, Aussie, New Zealand and Canada, the dollar, US dollar doing pretty well. But against things like the euro, sort of a mixed bag. Very interesting. It's going to be the renminbi. There's some talk that maybe the Chinese authorities want to sort of weaken that. I don't know. I think China, they're showing with these 34% tariffs that they want to sort of fight back hard. So therefore, I'm not sure how willing they will want, at least in the short term, to show kind of weakness by weakening their currency. And you can see here that the renminbi is hanging in there, certainly not weakening up into the 77.4 level, which is the key one. So that's what's going on here, guys. Oil, I should mention as well, oil absolutely, well, it looks, as I said, that was a bit of a bear flag. Took a while to develop. So oil, oh my gosh, absolutely collapsing here. So what I was saying is that it could go through this longer trend line, this gray line here. So it's obviously gone way through that and has broken down all these stops. The question here is what happens. We know that in the US, and the question also here is why did the OPEC Plus, just at this sort of very delicate moment for global growth, why did OPEC Plus actually sort of increase their output? And some of the theories are that if you look at, let's say, the Dallas Fed survey, the average break even for US producers is about $65, about $65. And you'll notice here that these levels are all at about 65. And so there's some theories going around, some commentary that maybe OPEC has sniffed an opportunity here. OPEC Plus has sniffed an opportunity and is basically saying, hey, let's take a little bit of short-term pain. Will increase production just at this delicate moment when global growth seems to be stalling a little bit, or the fears of it are growing, push down the price through overproduction. And the idea here is that if they keep it here, late 50s, early 60s, this could put a bit of pressure on some of those more vulnerable US producers whose break even at 65. They stop producing, and this is an opportunity for the OPEC Plus producers, the Saudi Arabias, the Russias, the Iraqs, and the Irans, maybe to take back some of that market share from the US producers. So I just wonder if this is part of the grand game here, because the OPEC Plus participants are certainly not stupid, and they understood that at this delicate moment for global growth, these kind of stories, to actually produce a little bit more is sort of symbolically was always going to kind of crash the market here. Well, not crash the market, push the market down. A lot of this is definitely sort of the Trump and the China retaliation. So the question now remains, is this a buy on dip? Certainly with these two red candles, you'd want to see a little bit of stabilization, but this could be interesting, over the next 3 or 4, 5 days. If we start to see some kind of basing pattern here, maybe some, sort of out of the money call spreads, it could be interesting. So but today's probably a little bit premature. Okay, guys, what I also wanted to talk about is non-farm payrolls, of course. So let's have a look at non-farm payrolls. And really the question now is, if we just go back and look at what's going on here. So let's just check there's no other crazy headlines coming in. Yeah, 2-year yield absolutely collapsing here. So if we just look at what's expected today, and I'm going to do this pretty quickly because the calculus is, this is that, first of all, this is the March number. We're now April the 4th. So the point is here that this is a backwards looking number in some respects. And just to see, let's just quickly see what market participants are expecting here. And because I always like to do that. So we do have the standard deviation here for about 25,000. We've got people thinking up to 200,000 and down to 80,000. So between 200 and 80,000 is the kind of dispersion. Standard deviation about 25,000 with the median of 140. So anything one standard deviation would be 165 and then 190. And then on the downside, that would be, what's that, about 115 and then about 90,000 on the downside. So always keep that in mind. So let's look at the unemployment rate, 4.1. So the thing is, the market is expecting here the median of consensus about, a relatively solid number. But a couple of points here. This is March. A lot has happened in the global economy, including literally half an hour ago, the China retaliation, obviously the Trump tariffs. So the thing is here, if this number is higher than expected, if we get 160, 170, 180, will the market sort of react and say, oh my God, wonderful, everything is great, the economy is super good, let's all relax? Or will it just completely ignore it and discount it? And it's going to be, I personally think the market will possibly discount this higher than, if there is a higher than expected number. And so what does that mean? It means that maybe if stocks go up, there could be a sell the rally situation. It's going to be super interesting if we get a higher than expected number and the bonds dip. Will they be immediately bought after an hour or two? On the other hand, I do think if we get a low number, let's say, 1 or 2 standard deviations below this consensus, so something like, maybe 115,000 or some, 80, 90,000, something like that. I think the market then will really run with that narrative that the economy, the real economy is weakening, that the Trump tariffs is already sort of starting to, at least in sentiment, to be felt, and that the labor market itself is weakening. So I think it's a little bit asymmetrical in the sense that a lower than expected number, a weak number, I think that will confirm the kind of the market sell-off, the jitters that we've been seeing over the last 2 or 3 days. And I think we could be in for sort of a pounding, really like sort of a lot of liquidation sort of happening. On the other hand, if we get a higher than expected number, we could see some stability, even a little bit of a bounce in the equities, maybe a bit of the US dollar going up, maybe the bonds selling off a little bit. But I do expect that to be reversed, or at least it's going to be kind of interesting sort of price action to see that. So what I'm trying to say is let's not assume that if we get a number of 160, 170, 180, suddenly everything reverses. It might reverse for a few hours, but I think, Friday afternoon, with the danger of headlines over the weekend, we could get sort of headlines of European retaliation. Who knows, maybe further comments from Trump, and let's see how Trump and the White House responds to this Chinese stuff. But that's where we are. So as always, interesting to look here at the private payrolls, see if they're holding up and whether this is like a government slowdown, whether the Doge cuts in the government payrolls is going to be reflected. So interesting to look at some of the numbers. Also, of course, we want to be looking at this inflation number. So the average hourly earnings, 0.3. Again, the Fed is starting to get themselves in a pretty complicated situation here. And I just want to start looking at a few things here about the Fed, because of course we have Jerome Powell speaking at 11:25, and he's starting to get in a very difficult situation. Let's look at the SOFR curve here, and what we can see here, this is the SOFR curve, and you can see here that the low point of this, so the terminal rate at this point, has gone down to 2.85. That's gone down a lot. Now let's compare this to a week ago. So what you guys can see here is that just from 1 week ago, so the terminal rate, as I said, is now about 2.85. It was a week ago up at about 3.45. So it's gone down almost 50 basis points. And even looking from 1 day ago, so this is now 1 day ago. I'm just going to zoom in here so it's a bit clearer. So even from 1 day ago, which is the yellow line, so this is the live data is the white, and you see from 1 day ago, which is the yellow, it's gone down a lot. So a lot of dovish repricing here. If we look at the dot plot, this is actually pretty fascinating. So keep in mind that the green arrow here, or no, the green line, is what the Fed members were saying at their last meeting. And you can see here that at the end of 25, they were saying that it would be at 3.387. But look where the market is now. This is basically the market pricing. So the market is way, way, way. So almost like 100. How much is that? That's like 3.15. 3.8. So it's about what, 70, I don't know, 70, 75 basis points more dovish than the Fed's last dot plot. So about three cuts difference. And that's reflected if we look at the just what's going on here in the current pricing, as I say, about 7:30 here in the morning on Friday. You can see here now, suddenly, those who followed this video, this was at 2.5, 3. Suddenly we're at 4.7 cuts. So 117 basis points of cuts suddenly now priced in. So the market, the last couple of days and overnight and this morning, is starting to scream at the Fed to say, hey, the real economy, this is a real big problem with the Trump tariffs, China retaliation. The market, anticipate a significant slowdown in the real economy, and the Fed will have to cut. And so, but the problem is here, if you look at inflation expectations, and I'll try and bring that up. Let's see if I can bring that up just while I'm talking here. Inflation expectations. Let's have a look at US macro here. So I just want to find inflation swaps. Yeah, so the problem here for Powell is that the status quo is kind of just say, oh, and we've seen a couple of Fed speakers in the last I'm just going to bring this on to daily. Over the last couple of days, this is kind of the status quo has been, okay, we're kind of on pause. We've got to ignore just for the moment the short-term price level changes, which could be brought about by sort of like a one-off tariff thing. And there was this whole idea of saying, oh, with tariffs, This could change the price is just a one-off kind of price adjustment, then things will stabilize. We're going to be data dependent. Policy is in a good place. The mandates of keeping price stability and full employment are broadly balanced and broadly in equilibrium. And that's kind of what Powell and company have been saying over the last 2 or 3 weeks. And that would be the status quo. Now, if he were to come out today and say that, that wouldn't be anything particularly new. And at the margin, that would sort of indicate that Powell's just ignoring all of this price action. And I think that would be, hawkish for kind of bonds and stocks, and would basically indicate that Powell, doesn't particularly see the need to change anything or to agree with the market pricing, and basically wants to sit back and sort of see what happens for the next month or two or three. So that's kind of the status quo kind of situation. So the question is, what would create something new, a new dynamic from Powell today? So I think there's a low probability possibility that he might really sort of start saying how much he's concerned about inflation, basically, and just say, well, that's a real issue. And you can see here the inflation swaps. You can see that they've gone up a lot, at least the 1 year. See this white line here is the 1 year. But Powell, what he's been saying is essentially like, yeah, guys. This is okay. We understand this, but this is just sort of going to be a temporary one-off thing with the tariff fear of tariffs. And if you actually look at longer term inflation expectations, so you can look at, let's say, something like the 3, the 4, the 5 going out, the 10 and the 20, it's actually been going down. So what the market is saying is that, yes, there could be heightened inflation for, 6, 12, 18 months. But as soon as we get out to 2, 3, 4, 5, 7, 8, 9, 10, 30 years, actually the market believes that inflation will sort of come down again and will stabilize. And that could be almost like a bit of an economic recession or something. So there is almost two different messages being sent here by the inflation swaps market. You see very short term in fear of inflation spiking, but the further out the tenors you go, and you can see here, like you've got the 2, 3, 4, 5, 7, 10 and 30, you can see that actually going down. So it's going to be interesting whether Powell goes with this narrative and say, okay, we're not going to overly panic. But again, if he does voice concern about inflation, that also could be considered a little bit of a political kind of move, sort of criticizing Trump and the tariffs. So I don't know that he's going to talk too much about that. On the other hand, what would potentially, be market moving from Powell could be to validate this new dovish pricing. I mean, let's say we're now at 4.5 cuts for 2025, we've just seen. Could he validate that and say, that yes, it looks as though there's a lot of uncertainty. Inflation is not a huge problem. They are now squarely focused on making sure the real economy and the labor market doesn't weaken too much, especially if we get weak payroll numbers at 8:30. Remember, Powell is speaking at 11:30, payroll at 8:30. So it's going to be a very interesting dynamic there. And who knows, maybe sitting in front of him at the breakfast table, he has two different versions of his speech. We shall see. But for sure, if the labor market numbers at 8:30 are very, very weak or weak or weakening, could that give the green light to Powell to sort of subtly endorse or to validate this dovish pricing? So if he does that, if he does validate this dovish pricing, the short end of the curve is going to love that, pushing down yields, pushing up the price. That's going to probably steepen the curve a lot because it means maybe he's less focused on the inflation dynamic. So we could get like a front end led bull steepener there, with the front end yields go down and the back end yields maybe don't even do that much, but certainly the curve could steepen. Equities would probably like that in the short term. It'd be a bit of a pop. But again, the overall sort of macro environment and political environment is a risk-off one. So I think that the equity bounce, if that were to happen, would be probably a short at some point at a good level. Okay, guys, I'm going to leave it there. I just want to just go back and just check before we wrap this up that there are no. Okay, so we're seeing European stocks fall, as we know. US credit default swaps, or the credit spreads are going up. Actually, just why I have you on here, why don't we just quickly look at those, because we have them here. Just give me a second here. I'm going to bring up. So what I'm going to do is just to look at some credit here. So we've got credit developed market. I'm just going to look here at the high yield. So let's just look at the high yield. And what you guys can see here, this is a daily chart. So you can see the high yield over the last 4 or 5 days. You see here the credit spread. So the high yield, which was at about 2.6%, this is the spread over US Treasuries, is really starting to ramp up. And then if we look at the even the investment grade, That's also going up. So now up to about 1%. Has gone up about 25 basis points. So again, if we look at the spread, so both the high yield sort of junky bonds and then the quality bonds, it's going up. And if we look at the spread here, I've got the spread here. So this is high yield. And it's interesting. You can see here that that had been sort of coming down. But if we go and look just over the last, I'm going to zoom in here or zoom out. If we start looking, let's say since beginning of February, that's starting to go out. It was at about 1.8%. So now really ripping a lot higher, 2.8. So definitely that's, showing sort of a bit of fear in the market. And that's something you can look at just looking. It's going to be very interesting today. Again, just to finish off here, looking at some of these ETFs, which tend to track some of this stuff. And some of them are hedged for interest rate risk and a pure kind of credit fear, and others are not. But just where do I have those? I have those. Oh, here we go. So if you look at this is the investment grade credit. You can see here, this one here is doing okay. But if you look at the JNK, the junk, you see, and look at the pre-market. So we're starting to see a big difference here between the JNK and the LQD, which is the higher quality one. Okay, guys, I'm going to leave it there. Interesting times. Let's keep an eye out for the numbers and then Powell at 11:25. Yeah. Okay. Thank you. Have a great day and a great weekend. Thank you.